Most investors think paying down their mortgage is the smart move, but what if the bank actually wants you to stop? Interest-only loans flip the entire script on how we think about debt, equity, and wealth building. And the conversation is way more loaded than your lender's brochure will ever admit. Right now, with rates sitting at levels we haven't seen since the early 2000s, the interest-only loan is making a quiet, controversial comeback. And depending on which side of the trade you're on, that's either the best news you've heard all year or a slow motion warning sign. We're talking about a lending structure that dominated the pre-2008 landscape, helped fuel one of the greatest housing bubbles in American history, and still somehow managed to survive with its reputation mostly intact. Here's the engine under the hood. An interest-only loan lets you pay just the interest portion of your mortgage for a set period, usually 5 to 10 years, meaning your principal balance stays completely frozen while your cash flow looks suspiciously attractive on paper. Think of it like renting money from the bank at a fixed cost, with the promise that eventually, yes, you'll actually have to start paying it back, but future, you can deal with that. The optimism around these products peaked hard during the mid-2000s, when everybody from seasoned flippers to weekend warriors was using interest-only structures to stack properties like trading cards, betting that appreciation would do the heavy lifting. Then 2008 happened, values cratered, and a lot of those investors discovered that having zero equity in a falling market isn't a strategy, it's a trap. But here's what the pessimists miss. Used correctly, interest-only loans aren't reckless, they're a lever. The psychological challenge is that we're wired to equate paying down debt with doing the right thing, when in reality, forcing principal paydown on a high cash flow rental property might actually be destroying your returns by tying up capital that could be deployed elsewhere. Behavioral economists would call this the debt aversion bias. We feel virtuous, reducing what we owe, even when the math says otherwise. Meanwhile, the sophisticated operator is running the numbers cold, asking one question: what's the highest and best use of every dollar? And does accelerated equity buildup beat reinvestment into the next deal? Historically, real estate has moved in long, grinding cycles, roughly 18 years from trough to trough, a pattern documented all the way back to 1818. And interest-only products tend to surge in popularity right at the peak of the expansion phase, when optimism is highest and discipline is lowest. The irony is almost too on the nose. The tool that looks most attractive when markets are ripping is also the one that requires the most conservative underwriting to actually work. Let's bust a common misconception right now. Interest only does not mean interest only forever, and that distinction is everything. After the initial period expires, your loan recasts, and suddenly you're amortizing the full original balance over whatever years remain, which can cause your payment to jump dramatically, sometimes by 30 or 40% if you haven't planned for it. The investors who actually win with interest-only structures treat the lower payment not as income, but as a repositioning tool. They redeploy that cash into renovations, reserves, or acquisitions that generate compounding returns above the cost of carry. What you're really doing is borrowing the bank's patience and charging rent against it, which only works if your alternative use of capital genuinely outperforms forced amortization. From a pure return on equity standpoint, a paid-off or heavily amortized property can actually yield terrible percentage returns because your equity base has grown so large relative to your net operating income. Interest only keeps your equity lean and your return on equity metrics sharp, which is exactly why institutional operators love it. The retail investor sees low risk in a paid-off building. The institutional operator sees trapped, underperforming capital. The lesson history keeps teaching, and we keep needing reminders on, is that structure is never the problem. Execution and market timing are. An interest-only loan on a property with strong rent growth in a supply-constrained market, held by an operator with real reserves and a clear exit or refi strategy, is a fundamentally different instrument than the same product used to over-leverage a speculative flip in a secondary market with shaky fundamentals. So what's the move? Be boring, be disciplined, and do the math before you fall in love with the cash flow optics model. The recast payment, stress test your vacancy assumptions, and make sure you have an answer for what happens if rates are still elevated when your interest-only period expires. The strategy doesn't need to be exciting to be effective. It needs to survive the scenario where everything goes sideways at once. At the end of the day, every financing tool is morally neutral. It's the operator's process, patience, and position sizing that determine whether interest only becomes a wealth accelerator or a landmine. The best investors we've ever seen aren't the ones with the boldest convictions. They're the ones who can hold a position calmly because they sized it right and planned for outcomes they didn't want. Comfort doesn't come from certainty about where the market goes. It comes from knowing that your structure, your reserves, and your discipline are solid enough to handle being wrong. And honestly, that's the whole game. Not predicting the future, but building a portfolio that doesn't require you to. If you want help navigating any of this, whether you're looking at your first investment property, need contracting work done to force some equity, or want to connect with lenders who actually understand creative financing structures, check out our links in the description below.